Hi, I'm Molly Getz, a partner and practice lead at Greenspring Advisors. On behalf of Greenspring's Investment Committee, I would like to share with you a few highlights from market performance in the fourth quarter, as well as some thoughts as we look ahead to 2023. After three straight quarters of negative returns, all major indices were positive in the fourth quarter. Stocks outside the U.S. outperformed U.S. stocks, and bonds were slightly positive. However, the positive performance in Q4 was not enough to keep us from ending with all major indices posting negative returns for 2022. As we look ahead to a new year, a question on many people's minds is, are we headed into a recession? The Wall Street Journal has reported that two-thirds of economists from 23 large financial institutions that deal directly with the Federal Reserve are predicting a recession in 2023, so recession is a valid concern. If we do head into a recession, what does that mean for the stock market? As you know, Greenspring does not make predictions, particularly around things investors cannot control, but we can look at historical data to get some context around what impact past recessions have had on the stock market. We can reference how the U.S. stock market performed over the past 50 years' worth of economic cycles. The economic or business cycle refers to fluctuations of the economy between periods of expansion, growth, and contraction, recession. Factors such as gross domestic product, GDP, interest rates, total employment, and consumer spending can help to determine the current stage of the economic cycle. Let's turn to the numbers that have accompanied this cycle. The average monthly return for the U.S. stock market has been negative 0.21% during recessions and 1.2% in expansions. Because we are more often in expansion, which averages 72 months, than we are in recessions, which average 11 months, it works out that the average during all months has been 1.02%. Makes sense, no big surprises. If you dig into this a little deeper, things get more interesting. If you divide the recessionary period of the economic cycle in half, what we have seen is that stocks do pretty poorly in the first half of a recession, averaging a negative 2.51% return. However, the second half of the recession, when we are just about to hit the trough of the economic cycle, returns average a positive 2.15%. This is even higher than the average return during expansion, where the market averaged 1.34% in the first half of expansion and 1.05% during the second half of expansion. At first blush, this may seem counterintuitive. Markets do best when we are in the throes of a recession and about to hit the trough. We need to remember that the stock market and the economy are related, but don't move in lockstep. The economy tends to be more backwards looking. What were the inflation numbers last month? What was the unemployment level last week? What was GDP last quarter? The stock market is more forward looking. What do we think earnings will be for this company next quarter or next year? By the time we hit the second half of a recession, a lot of the bad news is already priced in, resulting in attractive valuations, and as uncertainty begins to dissipate, we can see the light at the end of the tunnel. Armed with this data, can we make an informed decision about changes that should be made to a portfolio in anticipation of a recession? Actually, we can. This data only reinforces how important it is to stick to an investment plan and not try to time the market. To realize the best outcome, we need to stay invested during all parts of the cycle, even and especially during the descent into recession, when the ride may feel a little out of control to even a seasoned investor.